I wouldn't call it like a record to report process. I'd call it more like a record to report adventure with some sidetracks and sidebars. But the reality is that I think obviously there's two things. We need our financial reports to be accurate, and we need them to be timely. And probably accuracy trumps timeliness. I think to a large degree, I think that's totally comfortable. But the starting point is, where is the source of data? Where are your boundaries? How good are they? And how accurate is the data?
Growing a business requires a holistic approach that extends beyond sales and marketing. This approach needs alignment among people, processes, and technologies. So if you're a business owner, operations, or finance leader looking to learn growth strategies from your peers and competitors, you're tuned into the right podcast. Welcome to the WBS Podcast, where scalable growth using business systems is our number one priority. Now, here is your host, Sam Gupta.
Hey everyone, welcome back to another episode of the WBS Podcast. I'm Sam Gupta, your host and principal consultant at digital transformation consulting firm Elevate IQ. Record to report business processes typically take the backseat with ERP implementation projects, as O2C and P2P get the most limelight due to the customer-facing nature of these processes. Also, the decision made to streamline O2C and P2P processes and improve the cycle time for these transactions will have implications on the record to report processes. As you grow, your finance department is likely to grow as well. And if you cannot streamline, your SG&A will likely to grow faster than your revenue. So what do you need to do to streamline your record to report processes? In today's episode, we invited a panel of cross-functional experts for a live interview on LinkedIn who brings significant expertise to discuss record to report business processes and best practices. We covered many grounds, including the scope and branches that extend from record to report processes, the roles, and the organizational structure of the finance department. Finally, we discussed the communication and collaboration of different systems as part of the architecture for the finance department and the best practices for process design across these systems. With that, let's get to the conversation. Hello, everyone. Welcome to today's show. And if you are joining for the first time, this is part of our digital transformation series, for which we meet every Thursday at 5:30 p.m. Eastern, and we pick one topic related to digital transformation. And we always have a very exciting panel that is willing to share their insights and wisdom. For today, the topic is going to be record to report process. And now some of you might not be familiar with this process because that is not the first process that you hear in the ERP community. And that is not the one that gets a lot of limelight, because you are going to have other processes such as your order to cash and procure to pay. But record to report is extremely important. Even if you have figured out those two processes, this is going to be super important. So we are going to be digging into that for today. But before we do that, we are going to start with everybody's intros. I am going to start with my intro. If you don't know me, I am Sam Gupta. I'm principal at Elevate IQ. I have roughly 20 years of experience leading large ERP and digital transformation engagements. And record to report is definitely a topic that is always at the heart of the conversation when we lead these ERP implementation. At Elevate IQ, we do a lot of things from the ERP perspective. That is going to be business case development. It's going to be business process redesign, system selection, ERP selection, business architecture definition, enterprise architecture definition, and the ERP implementation. On that note, I am going to move to Chris for his intro.
Thanks, Sam. I'm Chris Garradini, president and owner of Turnkey Technologies. We've been implementing Microsoft Dynamics ERP and CRM solutions for the past 27 plus years. So glad to be here.
Okay, amazing. Thank you so much, Chris, for being here. Phil, can I ask you to introduce yourself next?
Sure. Hi, everybody. I'm Phil Kerper, Managing Director of Ringling Business Solutions. After several decades in the C-suite with mid-market companies, I stood up Ringling last year to help executive teams implement digital transformation and a lot of ERP activity as well.
All right, amazing. Thank you so much for being here, Phil. Mark Keynes, and we are going to have a little fun today because we have two Mark in the forum. Mark Keynes, can I ask you to introduce yourself?
Yeah, so hi, I'm Mark Keynes. I'm the CEO of BlueLink ERP. We are the manufacturer and implementer of the BlueLink ERP system, which really focuses on small and medium-sized businesses in the product-based space. And I'm very delighted to be here, rookie, and looking forward to it.
All right, amazing. Thank you so much for being here for the first time, Mark. Dave, can I move to you next for your intro?
Sure. Thanks, Sam. Hi, everybody. My name is Dave Chrysler, and I own an operations consulting company working with business owners and leadership teams to help them systemize their business. Come to you with more than 20 years in the manufacturing space, directly responsible for operations. So excited to be here with everybody. Thanks.
Thank you so much for being here, Dave. Mark Lilly, can I ask you to introduce yourself?
Yes, thank you, Sam. Good afternoon, everyone. My name is Mark Lilly, President and CEO of LillyWorks. The folks behind LillyWorks created ERP systems such as Profit Key and visual manufacturing. Now at LillyWorks, we're helping manufacturers improve their production performance and solve the late problem by tying into your existing ERP. Very looking forward to the conversation. Very happy to be here today, Sam.
Okay, thank you so much for being here, Mark. And before we dig into the topic, in the audience, if you have any questions, make sure you are going to be commenting in the chat box. We are going to be reviewing those. We will try our best to cover all of your questions. But if we run out of our time, our panelists are going to get back to you with your questions and comments. On that note, I am going to start with Chris with the first question, and that is going to be just to set the stage of what is going to be record to report process, what is going to be the process boundary that companies should be expecting when they are analyzing the record to report process, what are different user roles that are going to be involved in this specific process, and what are going to be their roles and responsibilities as they interact with the process.
Thank you, Sam. So record to report, interesting topic, and most people probably react and think, well, don't I report once I record it? And that may not be a true statement, because if you think about best practices and really controlling the process, mapping through all these different data points that may be coming from one extreme portion of an intact system, or it may be coming from a third-party system. But as we look at recording, we look at timing, we look at validation, before we tell somebody it's okay to take actions based on the data. So that's the real concern is, am I premature? Did I grab a report? I made a decision. Oops, the data wasn't cooked. I only had half the entry, not both sides of the entry. So as we analyze the processes, each one's going to be distinct, and we have to understand timing. And what is the gate? When do we say we're done with this? We're not editing this data. Any adjustments have to be so-and-so. Because the other thing that can't happen is once everybody says, hey, the reports are good, they can't move. We can't throw things back behind the line and move them. So if you think about analyzing that process, this record to report, each data stream, whether they're sales transactions, whether they're accruals, whether they're adjustments, whether they're allocations, because there's a lot of general ledger stuff that happens off book before I can look at financials, but even subledgers. Am I able to look at sales activities? And again, so these policies and what's the inspection? It says that data is ready for somebody to use it for decision making. Again, that's where I'm going to start and stress some of the importances of looking at these different data streams and timing around the data and the validation. So
could not agree more. And thank you so much for setting the stage. I think that's a wonderful stage, overall for the record to report process. I completely agree with your comment. And in fact, I enjoyed the comment when you said that, if you are not going to have complete data, then you are going to have a lot more downstream implications. In fact, I am probably going to have a clarifying question for you related to this. And that is going to be, typically, nobody really argues with, the sales team and salespeople, as you know, Chris, right? Finance is not going to have as much clout in this equation. So obviously, when you are going to have incomplete data, and that is typically going to be because you are trying to expedite your sales processes, you are trying to expedite your operational processes, but the guys who need to suffer the most are going to be the financial people, as we all know. So have you seen any sort of best practices where you can manage the expectation and you could have like significant downstream implications that is probably more, could be more expensive in doing the business itself, for some of these transactions?
Yeah, and I think one of the things that goes there is how do we lock periods? I'm going to throw that out there where, and you're alluding to the salespeople where they're fudging their numbers and then they're going to reverse them in the next period. And that's, are they gaming the system? How do we create controls where we don't game them? Because say go put in a fake transaction and then they delete it. Okay, well, as long as we got audit trail, we could tell that you can't delete it once you create it. But I think you raise a great point. But understanding those weaknesses and exposures and how do we lock this where It's not subject to revision any longer. We can tell if somebody's monkeying around with the data.
Yeah, exactly. The system sucks because I cannot really do undo. Thank you so much, Chris, on that. Phil, I'm actually going to come to you for your commentary, related to the process boundaries. As you are going from your record to report process, where it starts, how it flows through, where it ends, how many different users are going to be involved during the process, what is going to be the process boundaries for each of the roles as they are interacting with the process.
Right. So I think when a lot of people think of ERP on the financial side, they say, well, we just got to map to the GL and we're done. And I think this topic really talks about what dynamically is happening in the business from when the transaction occurs to when the GL is implicated or loaded with data, and then really getting to the point so that data is able to be reported in a good way. So who's involved in that? Well, on the transaction side, you mentioned the sales guys. It's always fun to pick on the sales guys, but you got a lot of people entering data in the system. Yeah. And there's a period of time where that data had to kind of echo what Chris was saying, where that data has to be made sure it's right. A very common question we get is, well, can I reopen an old period? Right. And the answer is no. I mean, you technically probably could, but the answer is it's a horrible process. I've been in companies where they don't formally close the period for an extended period of time just so they can go back and do additional data work. So the discipline that Chris was talking about to say, our data's right at the process period, it's correctly mapped to the GL, and then when we're closing and we're working towards how are we going to pull that out in reports or other information, that we're making sure that that information is right, because number one, it was right at the transaction piece and caught there, and certainly right at the point where we're closing the GL. So who's involved? Everybody who's entering or doing transactions in the system is involved at the report stage. Anybody who's interacting on the prod side of the system, and then certainly on a finance team is involved when you're doing the GL closes and when those things are being firmed up. And then the users of those reports, which can be all the way to the board, all the way to other people that are using that data, are certainly involved on the back end. And they need to know where it came from and that it was right. And they also might want it in different formats and in different consolidation documents, either on the financial consolidation or on the reporting side.
Okay, amazing insights there. And I completely agree. And I think you guys are touching on the similar points, you and Chris, that, whoever is entering the data, I think we need to look from their perspective, what data they are going to be entering and whether that is going to be complete or not. And that is going to have downstream implications if your reporting is going to be accurate or not. The follow-up question that I'm going to have for you, Phil, is going to be related to the opening of the period. And I know we have danced around this a bit, of the opening of the period. In some cases now, especially with the supply chain interruptions, we have seen that now opening of the period is probably going to be required because your transactions are spent across months. And if you have your monthly close cycles, some of the systems that we have in the market, they prescribe that, you are not supposed to open the period. You cannot open the period. But some of the systems are going to be slightly more flexible. So what have you seen in your experience? Do you go, are you going to be extremely strict that, you never open the period? Or sometimes you allow the opening of the period?
Well, it's going to depend what type of company you are, right? So it first starts with GAAP, and where there's a matching principle that in the period that you're talking about, you're matching the transactional work towards that period. And if you're a public company, and you're going to have to be very disciplined about that. But then in accrual accounting, you obviously can carry some things forward as an accrual and then be able to do additional work on those transactions in the following period. And so there's some leeway there. I think it's getting looser on this because of the supply chain issues. I think people are stretching the boundaries on that more than they used to. And at some point, there'll probably be a snapback of where people maybe got too loose. But if you're a private company and you're just issuing an annual report, there's really no requirement that says that you can't leave a period open that's within the year and then come back to that. So then it really becomes a discipline issue of, are you creating a lot of inner year noise if you want to know what the second quarter looked like quarter over quarter, and yet you let that period be open and did a lot of extra transaction work or went back and tried to true things up. It can absolutely make for bad decision making in the future when you're trying to understand the relationships between periods. So to go directly to your question, I advocate very, very firm restrictions on the opening and closing of periods. And kind of like someone who wants to customize software when they're doing ERP, they better have a darn good reason why they're leaving that period open or not opening properly.
Yep, amazing insights there. Thank you so much, Phil, and I completely agree with you. Okay, Mark, so I am going to come to you with the same question, and that is going to be the process of the record to report, how that is going to flow from the beginning to end. Obviously, you can agree or disagree with the panelists that they have already spoken, or you can talk about the process, users, their interactions with the process, record to report.
Sure. Okay, thanks. Well, I think that one of the important things to me, and also just for context, is that my experience is mostly with smaller owner-managed companies. And, it's kind of like a little bit, I wouldn't call it like a record to report process. I'd call it more like a record to report adventure with some sidetracks and sidebars. But the reality is that I think, obviously there's two things. We need our financial reports to be accurate, and we need them to be timely. And the probably accuracy trumps timeliness, I think, to a large degree. I think that really goes to Phil's point about not reopening periods or not closing them until you're comfortable. But the starting point is where is the source of data? Where are your boundaries? How good are they? And how accurate is the data going in? And to that end, I think one of the best practices out there is, first of all, eliminate manual key entry wherever you can and whenever you can. I don't care how much you spend on it, it's going to pay it back multiple times. There are so many fairly large companies out there that are receiving EDI orders from their customers, printing them out on a piece of paper, and then manually keying them into the ERP system. No. The answer is just no. Don't do that. So there's that aspect. From a timeliness point of view, there are a lot of companies. In fact, I would even say most companies are using more than one primary system for their key business data and even transactional data, whether it be an e-commerce site tied into the ERP or whatever. And again, I see too many of them where there is either no integration or improper integration. And I think that's another area that many companies can improve on because, hey, if you eliminate a lot of manual entry and you improve both the quality and the timeliness of your integration between systems, then when you get to the point of reporting, you're not playing catch up on your core source transactions, your procurement transactions, your order to cash transactions, they're all there. And then really your reporting cutoff relies largely on what do you have to do, things like accruals, things like dealing with deferred revenue cycles and things like that. Your true finance and accounting department has control, and the data that they're working with when they start their closing and reporting procedure is, again, it's there quickly and it's accurate and on time. I do want to say that, one of the things that I think both Chris and Phil kind of touched on was this whole thing of, of changing the numbers after the reports. I had a very unfortunate customer 20-ish years ago who decided to he was the general manager of a subsidiary of a large German healthcare corporation running in Toronto. And he decided to reopen the previous period because there were some late-breaking costs that he hadn't taken into account. And he revamped the sales reports. It wasn't even financial reports, it was sales reports. So people at head office had a sales report with, let's say, $1 million in sales and a 30% gross margin. And then 3 days later, they got a report with still $1 million in sales, but only a 22% gross margin. And about 3 days after that, he was fired. Maybe you don't want to be so quick to change the numbers.
Okay, amazing. By the way, Amici, I love the story in these panels, and thank you so much for bringing that story. That was amazing. And by the way, we are doing a little bit of carryover from our last panels. One of the things, and Chris and Mark Lilly were there in the last panel, and one of the key themes was touchless. Here you are also talking about the similar principles. If you are going to reduce the touch points in the process, then you are probably going to have far more data. So reducing the manual touch points that you have mentioned, reducing the manual interactions with the process, and that's where you are going to get real insights with your process. The follow-up question that I'm going to have for you is, because you are from a very unique industry, and I don't know if anybody else in the panel is going to have as much depth in that industry. So obviously you have the financial regulations, but then you have the industry-based regulations. So have you seen anything in your industry that other industries may not have? Pharma being your industry, in my experience.
You're right. One of our verticals is the pharmaceutical distribution industry. And yeah, there are reporting requirements there that are quite, depending on whether you're distributing controlled substances or just over-the-counter substances. Either way, you've got FDA and to some degree DEA and state licensing board reporting regulations. And most of them are actually, in terms of timeliness, most of them are actually, you have more time than you would expect in a situation like that. But some of them are very, very time sensitive. And there's one particular electronic report that has to be filed with the DEA for certain customers where you have, I think, 10 days from the end of the reporting period till submitting the report. And that data better be 100% correct, like not even 99% correct, right? But it is a little different than financial reporting because those are very much transactional and product-based reports. So way more granular, but realistically more, probably easier to actually procure in real time because as long as you have a proper real-time inventory management and order processing system, and again, as long as you don't have the manual data entry errors, messing it up, you probably already have the data like, by the next day, the day after the reporting period. So I think it's not as steep a challenge if the systems are good and if your standard operating procedures are followed. It's not as big a challenge maybe as timely financial reporting.
Okay, amazing. Thank you so much for those insights. So, Dave, I'm actually going to come to you. And the question is going to be similar to what I'm asking. Obviously, you can agree, disagree with the panelist if you don't agree with anything that has been said so far. But the core question that is floating around is going to be the whole process, the users that are involved in the process boundaries and their interactions with the process for record to report.
Yeah, thanks, Sam. I mean, yeah, completely agree with where everybody's going on this. And I think from my kind of experience and the things that I've seen, I'd like to add to what Mark is saying in terms of the elimination of those manual entry points and touch points. I've seen implementations for this particular process that have been done both ways. So starting out from a manual transaction standpoint, all the way out to the shop floor where data collection is being done completely manual. So if you think about it from that perspective, how many manual touch points you have in a situation like that where person out on the shop floor is actually manually handwriting their time and material reporting, which is going to another person in SG&A that is then hand inputting that information into the system and then generating variance reports to start to take a look at, okay, what types of transactions are we now looking at? How can we compile this data? How can we start to look at that? So that's kind of one extreme. And then you start to introduce some process automation into that and looking for ways to not only streamline the touch points, but back to what Mark was saying, it's from an error reduction and efficiency standpoint, it's exponential what you can see when you start to do that, not just speed that you are able to review that data and identify variances quicker, but as you go into the chain and start to touch accounting with those transactions, how much more accurate that data is. So therefore, when the financial reports start to come back out to you, from a leadership perspective, and you start to review that, the amount of data that you're really sifting through to find those anomalies, to look at those variances are far less than what you would have in a more manual touch point system. So there are a lot of, back again to what Mark said, that there are a lot of considerations that go into going from one to the other, cost being, a significant factor for some of the solutions that are in place. But I wholeheartedly agree with his standpoint on that investment will more than pay for itself and will allow you to redeploy those resources that you're really tying up with, in some sense, menial work, right? It's super important work, but it's menial from the standpoint of all it takes is one miss key to create a bunny trail for several people potentially to go back and identify where did that transaction originate, how can I correct it, and then that carries into like what Phil and Chris were saying in terms of closing periods and everything out. I mean, what happens in the situation where you don't find that variance because it ends up being a minute variance in the in the micro, but in the macro it ends up compiling and you don't find it for a period. Well, then what happens? Do you go back? Do you correct? How does that ultimately impact the the financial statements that you're ultimately looking at?
Okay, amazing insights there. So I think there is a lot of agreement overall in terms of those manual touches. I think everybody's sort of touching the similar points that when you have manual touches, that is probably going to increase the overhead from the financial perspective. And you are absolutely right about your comment about the admin overhead, that is probably going to be unnecessary, for which you are using the word menial, which is true as well. So now, the question that I'm going to have for you about your comment, overall, this macro versus micro variances, not everybody is going to be clear about that. Do you want to touch a little bit more on that, how they work, where you are going to have more impact overall from the best practices perspective, where you might be able to minimize some of those macro and micro variances, Dave?
Yeah, I mean, kind of, I guess, at the high level, taking a look at that, when you are looking at the transactions and they start to compile, something that may not stick out to you on a specific, let's say, if we're going to continue on the production theme, let's say from a work order variance standpoint, when you start to look at that, something that may not immediately jump out to you as an issue from a variance standpoint. So again, that's the micro. As those compile and as that problem continues to replicate itself, that's where potentially you could see that in the macro. So that could be at the end of the month. It could be at the end of a quarter, as you start to see those variances stack up, where it may not immediately jump out at you when you're looking at it on a daily or an hourly basis. And again, all this is dependent on how your system is set up to deliver reporting back to you and how fully integrated that system is. So in kind of this example that I'm talking about, we were working in a system that basically had what I would consider daily reporting. So it's not quite real time, but next day reporting. So all of the work orders would be closed out. We would have access to financials and be able to look at variances that next day. So that's kind of what I mean. Hopefully that explains what I was saying in terms of that micro versus macro, and then potentially creating some issues when it comes to rectifying that or correcting, really, and not necessarily rectifying, but correcting what should have happened from the early stages.
It does. Thank you so much, Dave, for your insights. And Mark, I'm actually going to come to you. So obviously, you can agree, disagree with the panelists, whatever they have said so far, or you can cover the question, which is going to be the overall scope of the process. How many touch points are going to be there in the process? How many users are going to be touching the process, and what is going to be their interactions as they interact with the process? That is going to be required to report, Mark.
Sure. Yeah. Thanks, Sam. And yeah, awesome points across the board. It's hard to add anything. A lot of very strong points. I will again reinforce the idea that we want data to flow as much as possible, right, rather than have any sort of manual intervention. But I think most ERPs today, certainly, if you're putting the information in the upstream areas, even from a quoting standpoint and a sales standpoint, certainly, then that information generally flows and can be acted upon rather than having to be re-entered, right, and have all those opportunities for errors and whatnot. There is just such an amazing amount of information that any ERP system today holds, and I think the touch points is almost infinite, and it certainly is expands as the size of the company expands in terms of the number of users who are touching that information as it flows through the processes. But I think one of the big things that may not have been mentioned yet is that during an ERP implementation, I think it really behooves the company. And I've seen many companies not do this. I have seen quite a few do this with tremendous success. And that is to really go into the ERP implementation as a business improvement opportunity, right? And understand when they go live and it's 6 months after go live, what do they want to be able to measure, right? What do they want to be able to answer today? Or then rather in the future that they can't today. And that should drive what information they're going to need to know, the accuracy of that information, and drive the business processes all the way upstream to where the data needs to be input and relatively accurate in order to support those business metrics at the end of that process at whatever whether it's a very detailed or a high summary level at the end of that process.
Okay, amazing insights there. And I completely agree that, the to-be processes should be driving how your process design is going to be. And that's how you should be implementing your ERP. I am actually going to have a fun question for you, Mark, Lily, because you have been selling ERP for a long time. When I ask the question, what exactly is in ERP, obviously accountants and the controllers and the CFOs, they should be the first ones to understand what an ERP is. But in my experience, it's always challenging to explain that. And obviously, Mark Keynes is probably going to have a counter there because he has a lot of finance background. So here, when we look at the ERP system, so I will give you an example of how QuickBooks works and how your ERP systems work. So now, in case of QuickBooks, most accountants and financial people are going to use QuickBooks. And one thing that they can do in QuickBooks is going to be they can have a GL account on the bill when they are entering the bill, right? Now, QuickBooks make it really easy. You can do whatever you want. You can literally create an entry against any GL entry, obviously. You can do that in the other ERP systems as well, but that is not going to be at the AP bill level. It's going to be a separate GL entry. You cannot really correlate your bill with the GL entry. Now, the argument that I had with the controller or the CFO is that QuickBooks is super easy. I can do so many different things, but your ERP does not allow that. So what would you say to that?
Well, first off, certainly on a work order by work order basis, I think I'll just speak to the systems I have experience with. I have seen where you can tie in, you have a standard site level, say, WIP accounts, right? But on a particular work order, you can override those. So if you want those to go into an R&D account for prototyping, for example, or a specific product line, if you want to break out your WIP by product line accounts, then you can do that as well. Typically, I think what we see in QuickBooks is we interface with QuickBooks as well as that you've got to you have to set it up appropriately in order to send over the manufacturing costs, right? And that's really the key. Because the ERP typically, and especially an ERP that focuses around manufacturing, has much more manufacturing production detail and functionality than you have in QuickBooks. So you just have to set that up right so it flows over into and that you have the appropriate accounts in QuickBooks to capture it when you push it over.
Okay, amazing. Thank you so much, Mark, for those insights. So, Chris, I'm actually going to come back to you, and obviously you are going to be super happy with this question because my favorite topic always is going to be multiple systems and the architecture, and that is probably your favorite topic as well. So when we look at the record to report process and when we have the multiple systems, if you have just one system which is called ERP, your life is going to be far easier. But one system is never going to be enough for most organizations, okay? You are probably going to be bringing other systems that are going to be interacting with your ERP for your record to report processes. Some of the systems that you need are going to be your FP&A system, which is very, very common because obviously in the ERP, the reporting is going to be very expensive. It's just hard and do it far easier when you are doing either the FP&A system or the CPM system. There are other systems in the financial organizations. For example, let's say if you are simply capturing the invoices or bills, sometimes those could be technical systems. So how many different systems that you have seen in the architecture and what are going to be the process boundary as we are moving through our record to report process? Chris, over to you.
So again, some ERPs have robust reporting systems, but a lot of them lack the complexity needed to articulate budgets or forecasts that they want to compare actuals to. So when your example with a CPM system, you've got a third-party system, and typically you're building custom integrations from the data in the ERP to get up to the CPM system. So in that construct, you got integration jobs, and then does the CPM have all the data that's in the ERP? Because now you're replicating. And so I was even to say that at some point there should be some key performance indicators that tell you that, hey, my data is ready. There's integrity. I'm not missing transactions that need to be integrated. The two systems agree in a hash total. But to your point, that architecture can add some complexities because how often do you update? What's the single source of truth? Is it completely comprehensive? Does it have subledger data? Even the drill down. And again, when you have an inherent report writer built into the ERP, a lot of times you have that single click to go look at the source transaction, as some of us talked about. Can I really see that data? So again, architecture, typically there's going to be, and even the report writer in my world, it's kind of like a bolt-on, but it's part of the core solution. But it is still a report writer that has flexibility and some limitations. So again, as you get up to the enterprise level, people are going to go upstream for larger reporting tools. There's no question about that. So it adds that complexity.
Okay, amazing insights there. So I am going to have one follow-up question, and that is going to be, when you are doing the CPM system, obviously CPM system is going to be your analytical system. When you have the analytical add-ons, you are not going to have as much architectural challenges as you are going to have when your operational process is going to be hijacked. Because of the system. So here you are doing a bunch of study. Sure, you might be off in your report. That could have, some implications. I'm not saying that that's not that matters a lot as well. But when you have system that is really hijacking the process, that is going to have far more implication on your process. So have you seen any systems that are going to be hijacking the process? Related to my architecture question, different systems that are going to be involved. If you have any counter or any agreement, disagreement that has been said so far, obviously you can cover that. But what we are looking for is how many systems are going to be involved in the financial organization and how they are going to interact with each other when we are designing these process boundaries.
Right. So if you have a front end system that's unique, so the way I would answer that is and it kind of comes back to what Mark Haynes was saying. If you have a decent modern system, ERP, a decent modern CRM or whatever the other systems are, there's really good API technology in order to interact with those things, have the source of truth, and have that all good to go. Where I think it gets challenging is when you've got systems, if you will, that really are legacy. I had one client recently that literally on their IT stack diagram had one square and it said magic spreadsheet. A company that I worked with, they had a real challenge, a particular challenge where they had to calculate commissions for field guys. And those commissions had to be calculated on a very specific region. And often that type of information was not in the ERP. And so they had set up an outside the system methodology, if you will, in order to make that calculation, that reporting. Well, it was commissions for salespeople that were independent reps. So super important numbers. And here's the integrity thing. The numbers were slightly different in that methodology than what the ERP. So when you consolidated that report on sales and you consolidated the financials, you'd have two different sales numbers. Well, the sales guys would lose their minds over that. And they use that as none of the numbers are correct because the sales guys are being measured on sales. Yeah. So I think the answer to that, and maybe if Chris gets connection back, he can talk to Tech or one of the other panels. But the business intelligence platforms now, whether you're using an outside Tableau system or whether you're getting BI out of your ERP, you can now put some real discipline to how that data goes into a roll-up and make sure that it actually foots to what the financial reports are saying. And I think there's a real opportunity in mid-market companies that Mark Haynes has or that I've worked with these legacy techniques to get a certain report, for you to do that with BI and for you to make that so that is automated and so that's for sure footing to the central reporting that you have.
Just to add on to that, and the tools that Phil is describing, like Power BI and others, allow dynamic pivot tables, right? So if you're at all familiar with pivot tables in Excel, imagine being able to do that on your live data in your ERP, right? So it's not having to design a static report that's going to stay there and that's the report you're going to use forever. No, you can have your dashboard or your spreadsheet and drag and drop columns and do on-the-fly filtering, and super powerful these days. So I just wanted to reemphasize that point.
Okay, amazing point, Mark. Chris, you had a comment as well?
No, yeah, okay. I think Phil's right on. Can you hear me? As you think about manual refreshes on reports, you're right on. To develop the reports that are real time, directly generated off the data versus manual composition, we're going to eliminate some of these disparities. And as I was saying, are there key performance indicators on data integrity? It's about data integrity, isn't it? And how do you imply or use a KPI that says, hey, everything's in balance, we can run the report. So that's kind of how I was going with that. Even if it tells you, hey, I had 1,000 records to integrate, I got 1,000 in the system versus I have 990 and 1,000, it just flags to make sure that we know even before we go through the effort of generating reports that we've got integrity. And then again, eliminating the manual, right? And making sure we have the right level of detail behind anything that's integrated so that we can actually drill down and verify that we're looking at the right data. Because again, the worst thing you can do is make a bad decision off of bad data. So
okay, amazing insights there, Chris. And Phil, I am actually going to have a comment, on the comment that you made about the magical spreadsheet. In my experience, I think you are extremely lucky because you at least have the spreadsheet. In my experience, when I work with the customers, typically that magical spreadsheet is somebody's head. Okay, and then there is a finger pointing. No, you are off. The numbers are, you are off. Typically, that's how the conversation goes. So at least you have the spreadsheet, but obviously you are right that the information needs to reside inside the ERP system, and the systems need to be connected with each other with the data accuracy so that you have the real insight. If you are not able to reconcile the data across the systems, obviously there are going to be a lot of implications. Thank you so much for those insights. So Mark Keynes, I am actually going to come to you with the question that is going to be, when you have multiple systems involved in the architecture, how the process is going to move across the system, and if you could touch between the differences of the analytical process breakage versus the operational process breakage. Those two are very different things. I have not seen if there are any sort of process breakage in the record to report process, but maybe you might know some systems where some companies may require that. So in your experience, what has been the architectural experience when you were designing the record to report process?
Yeah, well, thanks, Sam. I think a lot of the systems that we've worked with tend to have a certain percentage of the initial transaction data capture in external systems. The most obvious ones being e-commerce systems. More and more companies are throwing up e-commerce sites, and I want to come back to that in a moment because there's an interesting sidebar there. But I think that's where a lot of the things that tend to break down because of, we all know the technology exists. You can connect your e-commerce systems to your ERP systems in real time, two-way, not a problem. But the people problem comes into place, right? So, we want to throw these extra 1,000 SKUs up onto the e-commerce site, and the person who's in charge of adding SKUs to the ERP is busy, tied up, sick leave, whatever it is. Yeah, we can't wait. We're just going to go and manually throw them on the e-commerce system, and we'll get caught up later. And then 2 years later, they're still getting caught up, right? And then the sale, you can't import the sales because we don't have the SKUs, so you can't create sales orders, and it becomes an awful mess. But I think on the other end of it, where I've seen some interesting variations is, and I think Phil touched on this a little bit. I think Mark did as well. You're not necessarily just reporting at the end of the R2R cycle. You're not just necessarily just reporting on general ledger balances. You're tying in information from other subsystems. You're reconciling the sales per the sales history versus the sales in the general ledger. Yeah, that's the most common thing I've heard as well. Is like, why did the sales not match? Very, very common. So you're putting those kinds of things together and you're putting them from different systems. So if you have the right reporting tools built in that can interact in real time with all the different areas of your record keeping in order to do that, your general ledger, your sales history, any other third-party systems that you're using as well, then that's great. But that's frequently not the case. So, what I've seen a lot of companies do, obviously, I'm sure everyone else has, is use the old data warehouse approach. So all the data from the various systems maybe nightly gets dumped into a data warehouse, and your reporting systems are therefore always accurate as of yesterday, but not of today, but as of yesterday. One of the biggest problems that I've seen with, again, size companies that we deal with that don't necessarily have the level of discipline and the experience, the people experience to really navigate these systems appropriately is when something breaks down, nobody seems to be aware of it. So, the data warehouse didn't siphon off the data from, the e-commerce system or something like that. And yes, there are alerts and dashboards, and no, nobody bothers to look at the dashboards or respond to the alerts. So, you get your financial report and the CEO has a look and says, why are sales down by 12% from the previous month? Like, what went wrong? I thought we were having a good month, right? Oh, yeah, I thought there were some alerts that I didn't pay attention to that I probably should have paid attention to. And so I think that's a problem in the size companies I say that I deal with. I actually would be interested to know to what degree that sort of scales up to larger enterprises. But frequently, like the main focus in many of the companies that we deal with is sales. And if you try and get somebody's attention on, what other things you should be paying attention to, it's very, very difficult. So one of the tools, and again, I think Phil kind of already touched on this, you can use business intelligence tools such as Power BI or Tableau, as well as like some of the better reporting tools like Microsoft SQL service reporting, SQL reports, to proactively warn you about conditions as they go along. And I'm a very, very big fan of like automated exception reports that go to the right people at the right time to get ahead of these things. So, like a really good example of an exception report that one of our customers, and it's actually one that I've kind of alluded to in the CEO who said, why is my sales down by 12%? It's that guy. One of the reports that we've given, that he is one of the people who receives the reports as well as other people, is a report that shows the sales booked through the ERP yesterday versus the sales booked through the ERP the same day last month and the same day a year ago, so that you can right away, and it is a seasonal business, so it should really sort of follow what happened last year. So you can try and catch those things up front rather than trying to cure them after the fact. So we've become very big fans of real-time exception reports and real-time dashboards, not only for giving you the information after the fact, but for alerting you to problems in the information. It's great to measure, your data against KPIs at the end of the R2R cycle, but it's even better if you've first made sure the data is right going in.
Okay, amazing insights there. And I especially enjoyed your comment about the SKUs because in my experience, people don't really pay attention to SKUs when they are thinking of the downstream processes, such as your record to report. And your comment about, sales being down just because you are missing a bunch of alerts is definitely spot on. But in your experience, when you look at these SKUs, and I have seen a lot of different implementations. In fact, I got off a call from a customer today, and they were saying that, I have state-of-the-art implementation, everything is just fine, there's no problem at all. But the SKU alignment is not there. The sales has completely different SKUs. The customer service is doing something else. The finance is doing something else. So obviously, there are going to be a lot of implications in the downstream process. Do you have similar experience, Mark Haynes, because of the SKU misalignment overall? What implications are you going to see in the R2R process?
Yeah, I do see a lot of that. But again, I'll just clarify that the size companies we deal with are generally, somewhat smaller. And therefore, they do tend to make very quick decisions and try and execute them very quickly. And honestly, sometimes that is, to be fair, in terms of their business operations, sometimes that's their strength. That's their competitive edge, is we can decide we're going to bring these new products on board. We can bring them on board and be selling them with our website like 24 hours after we make the decision, before we've even placed our first order. Problem there comes in is, you sell, and I see this all the time. You sell something, but you can't deliver it. Why can't you deliver it? Because what you sold is actually made up of three. I sold a bed, but the bed comprises a base, a headboard, whatever it is. It's got like 3 or 4 pieces. Turns out I only ordered 2 of those pieces. So, I've made all these e-commerce sales, but I can't actually deliver them. And I think we all know that, particularly in the sphere of e-commerce these days, there's very low tolerance and very low patience. You order your thing online today, and if it hasn't already shipped out by tomorrow, and you don't have a tracking number by tomorrow, you're like canceling the order and finding it somewhere else. So I think that's one of the more common areas that I see is make the decision. Again, it's almost always on the sales side. It's almost always driven by sales in my world. Make the decision. Think about how we can actually sell, how much we can sell it for, and how much profit we can make, and how we can get the customer's attention. And then, everybody else will deal with the downstream problems, but the downstream problems actually end up coming back to bite you often, right in terms of the sales, but even after the fact. See, I've seen companies make decisions on selling a new product line, sell it, deliver it, everything's great until you look at your gross margin afterwards and realize, actually, we lost money on that because we didn't take into account, for example, that the cost of, shipping from China just kind of trebled. We were still using our old container costs from, pre-COVID kind of thing.
Okay, amazing. Thank you so much, Mark, for that. I am going to come to you, Dave. And one of the things that have sort of been missed overall from the conversation when we look at different systems that are going to be involved in the R2R process. And I was hoping, that Phil is going to have a lot of insights. And Phil, obviously, you can comment as well in between if you like. But Dave, this question is going to be for you. When you look at the system R2R process, you are going to have a very important piece, which is going to be consolidation. And you are probably going to be utilizing a specialized system for that if you have multiple entities and if you have a lot of movement happening in the corporate development area when you're doing a lot of mergers and acquisition. And your background is there that you have been involved with a lot of different mergers and acquisition. So when you look at the R2R process from that perspective and you look at the systems that are going to be involved in your R2R process, what are the things that you have seen in your experience?
Yeah, thanks, Sam. First, let me say that that's an extreme challenge when when you are responsible for or a part of a company that acquires multiple businesses, that's a real challenge on your hands to integrate that process. And to start off with, it's obviously kind of first and foremost. So the things that get changed over from that initial acquisition phase are trying to get APAR moved over into, in the example that I'll use, a corporate system that's going to be back to what everybody else was saying, right? Like in an ideal world, you want the least number of systems possible to be touching this process. So in the acquisition mode, knowing that more than likely, right, 99 times probably out of 100, you're not going to be dealing with the same system. In more cases than not, you are going to be dealing with multiple systems in that acquisition facility. The faster that you are able to, number one, consolidate the current systems that are in place and eliminate some of the either manual entry or double duty of that. And then secondly, integrate and or implement the corporate system or the one solution, if you will, into that. The faster you can do that, the easier your life is going to be. Obviously, that is in an ideal scenario, and there's a lot of runway necessary to sometimes make that happen, all dependent on size of business, and those types of things. What kind of resources and support you're able to throw at that particular situation. But I think it's a great topic to talk about from that standpoint, and it at its simplest level introduces a lot more complexity to be able to close periods, to be able to get accurate reporting. I mean, Phil, jump in here if I'm missing anything from this, but back to what you were saying in terms of the accuracy of what you're looking at, the closing of those periods, and the ability to match that reporting process to what you're actually looking at. All of those just introduce additional variables and additional complexities to getting the people of that acquisition facility aligned with what you're trying to do from kind of a corporate strategy standpoint. So, Phil, if you've got something to add, happy to.
Great comments. I think you do run up against what's practical for the business. Similar to what Mark Haynes was talking about is the speed that you need to get something out on an e-commerce site versus what's practical for the business in order to have the back-end SKU work being done before you put that up on the site. Or doing an acquisition and having that company, there's only so much integration of the systems that's practical, especially early on in the journey of integration. You get the close and they're still sitting on a different system. And how quickly can you really move that over? I think the answer in both those cases is really about process discipline. And if you can convince the stakeholders, whether it's those sales guys we were picking on or the people that are trying to get those SKUs up, that the company doesn't get served and the customer doesn't get served unless we have real discipline on how we have data entered in the system, how we close orders or information, how we manage things. And then if you can't fully integrate it, at least you're bringing over with whatever technique you're using, something that's really good processed. And I would also add that the savings that you get we talked about earlier, where you might have people doing manual stuff, I always try to remind folks that I'm working with is don't count on headcount reductions with adding these platforms. You need to move those people or have different skill sets if you can't move those people into doing real disciplined things on the process side so that the systems work for you. So you got to convince the stakeholders that they need to invest in good process development and good process discipline as they're standing up technology in their businesses, or the technology not only won't work well, but it'll give them bad information and actually could hurt customer journey and hurt the business itself.
Yeah, the only comment I was going to add back to that, Phil, and again, completely agree with where you're at with that. But, I'm always reminded, and especially during those times that I was a part of those acquisitions and helping on the implementation side of things and kind of going through that process, it was, the phrase of that's the way we've always done it. And what was a real challenge with that is, to your point, looking at it from the business process side and really recognizing how to bring those two sets of, those two mindsets together is probably the best way to say it. Because when somebody is used to looking at data in a particular way and you're delivering it in another way due to a system issue, that could be a real challenge, especially on an acquisition front. So the faster that you can get people on board with and understanding the mindset of, from a process standpoint, what you're trying to do and how the data potentially could be different. And again, utilizing that to your advantage. So that way you are freeing those resources to be able to redeploy them in other ways. Being able to kind of do that in a real streamlined way has definitely helped ease some of those acquisition pains over the course of time.
Mark, would you like to touch the question from the architecture perspective?
Yeah, thanks. I think the one, I don't mean to be too much of a contrarian here. And look, I was, selling ERP for, especially in the 90s and early 2000s when the phrase was, an end-to-end ERP, meaning, all functionality in one system. And in general, that's wonderful to have, right? If all the data is supported by a single database, it's a great thing to have. I think what I found since then, quite frankly, is that, and especially where you look at ERPs that have already been implemented, you find that one group of people undertook, a certain implementation area, and another was kind of left. So a case in point is a bill of material structure, right? A bill of material can be designed to be reflective of production. It can be designed to be reflective of costing. And in fact, the same structure needs to be both, right? But that's hard. It's hard. And so oftentimes you see the cost accountants or the accounting folks designed and costed out the bills and materials because they wanted their costing in such a way, and kind of left the production folks on the sideline. So my point is, it's okay. In that case, you're probably not going to change that, right? So it's okay to have another system, assuming the integration is sufficient, tested out, secure, and all those wonderful things. But it's okay to have another system to support those processes in the right way.
All right, amazing. So guys, the only thing we can take at this point of time is going to be super short closing advice. And Chris, yes, we are going to start with you. You can touch on the comment or provide closing advice, brother.
That's fine. The closing advice is we look at record to report. We didn't talk about data validation. So if you can emphasize and get better control on data validation, you're going to spend so much less time on the backside making adjustments, correcting entries. But again, real-time reports, don't have people keying stuff, but again, focus on the whole process. Timing, when can we expect things? So that's it.
Right. Thank you so much, Chris. Good advice. Phil, super short closing advice, please.
Yeah, I think we have to do a better job of showing people why this is important, why the process discipline is important, and why if they want to get what they want, it's really important to make the investments, to make the data right, and to make the process of supporting that data right. The integrations and everything then can be worked out on the back end. So we have to do a good job of convincing people why this is important.
Okay, amazing. Mark Keynes, one sentence closing advice, please.
I would say it's important to get your SOPs, your standard operating processes, in place and get them working, and then not forget about them, but keep looking at them, reviewing and revising and updating them, because they're going to get out of date real quick.
Love it. Thank you so much. Dave, super short closing advice.
Yep. Understand your business processes and look for ways to eliminate manual data entry.
Awesome. Love it. Mark, super short closing advice.
Almost ditto. I'd emphasize, look at where you want to be from a KPI standpoint, put in the processes and the data acquisition to support that.
All right, amazing. So guys, that's it for today. If you joined for the first time, this was part of our digital transformation series, for which we meet every Thursday at 5:30 p.m. Eastern. We pick one topic related to digital transformation. We always have a very exciting panel for you, and we are going to be here next week. So make sure you are not going to miss next week's show. On that note, I want to thank everybody for their time and insights.
Thanks, Sam. Thanks, everyone.
Thank you for listening to another episode of the WBS Podcast. Be sure to subscribe on your favorite podcasting platform so you never miss an episode. For more information on growth strategies for SMBs using ERP and digital transformation, check out our community at WBS.rocks. We'll see you next time.